All right, so you are welcome to lecture 2 of our incomplete records that we are doing. And today we are going to look at a 5 or a 6-step approach that we use to actually prepare the final account. So what we are keeping an incomplete record. All right, so we learned from last week in the first video that anytime we want to get profit, we need to go back and visit the accounting equation because we can use the accounting equation to actually obtain profit. And we learned that the accounting equation is equal to assets. Assets is equal to capital plus liabilities. And we use capital because we expect that the person who is keeping an incomplete record is a sole proprietor, sort of, not a company. Now, you need to also understand that if I want to get some examples of assets, here is categorized to fixed asset or NCA, non-current asset. And you know, from the very first beginning of basic accounting, I gave you examples of the things that are there. Then you have current assets. So that is that, current asset. Then you know some of the things that are in equities, especially for a sole trader, will be the net profit or retained earnings, or what we call income surplus. All right, retained earnings. Of course, there are certain things like share dues, share capital, share premium. Okay, but here, hardly will you have the share components because these are sole proprietors. All right, so it is very difficult to have them as issuing shares. So because the retained earning concept is here, retained earnings means accumulated net profit. So basically, inside the retained earnings is the mother of net profits. All right, then here, when it comes to liability, we have non-current liability or long-term liability. Then you also have current liability, and you have examples of these things inside the very basic accounting video. All right, the first on the playlist. Okay, now because profit was found here, we could say that we can have profit from the capital calculation. We also learned last week that capital, by change of subject, it's equal to assets minus liabilities. So what we learned was that if I want my capital, I can do assets minus liabilities. All right, so that is what we went through to do. And we said that because profit increases capital, we said my opening capital, therefore, plus any additional capital that I introduced, all right, plus profits, because profit will increase capital, minus any drawings that I do, will be equal to my closing capital. So basically, that is what we learned. Now we are going to use this one. What you do with this one, asset minus capital, asset is equal to capital is equal to asset minus liability. What we do in that thing in a statement form, is what we call statement of affairs. All right, so that is that, statement of affairs. So today, even as we are going to go through and do, and you see, as we've done this, for you to even get your capital, you have to get these and these. All right, and for you to also get your profit, you have to get these ones. All right, so we are going to find out how we can get some of these things. So if you are asked to prepare a final account, where a final account simply means a P&L and a balance sheet. All right, so if you are going to prepare a final account, there are 5-step approach that I want you to follow to get that done. All right, so the first thing you need to do is to do Statement of affairs. Statement of affairs with the opening figures, all right? Opening. So this one, opening figures or the closing figures of last year. So you are using, let's say, closing figures from last year or opening figures from this year, okay? Or opening figures of this year, the current year. All right, so that is that. What are you using that for? If you do this, what you will find is your opening capital. You find is your opening capital. So that is what you do. Okay, then the next thing you do, step 2, is to draw up our cash book. So what we learned from the journals, day books. So you draw your cash book. And this one, maybe a 2-column cash book or something. Okay, so that is that. Now, when we do this, this one is to help us obtain our cash balances. Our cash balances. Now, sometimes, if these things are missing figures, then what it will help you find is actually drawings. All right, so you can get your drawings out of it. But the purpose is obtain your cash balances. All right, so that is what you do. Step 3 is to do your sales ledger control account and purchases ledger control account. So that is what you do. Sales ledger control account, purchases ledger control account. So that is what you do. So which one do we start with? Let's say sales ledger control account. So prepare a sales ledger control account. All right. Now, this is how you prepare a sales ledger control account. But before then, let's have an idea how we prepare our cash book. So cash book is simple. So you open it like this. Most of the time, these ones sounds like a 2-column cash book because of cash and bank. All right. So prepare your cash book nicely. Oh, my line. All right. So you have cash and you have bank. Cash, bank. Now watch this. All assets in the accounting equation, like we've said earlier, all the assets, these ones, you see, this is like this. So it means that everything that is here has a debit balance. Then everything that is here has a credit balance. When we say something has a debit balance or credit balance, it means that its balance brought down, not carried down, not CD, the BD will be at the debit side. And we say something is a credit balance, it means its balance brought down will be at the credit side. Please take note, it is not the CD, but what? The BD. All right, take note of that. All right, so that is that. Now, the trick is that cash can have both debit balance or credit balance. Now, under normal circumstance, cash is an asset, all right? So it should be having balance brought down like this. So you put them in, all right? So that is that. So on the credit side, you have overdraft brought down. So if it is an overdraft, please don't forget you put it there. All right. So that is that. Then what do you do next? You see, every payment. So all payment. So all forms of payment. All right. Payment, either expenses or payment to suppliers. They all come here. It can be cash, it can be bank. So it can be any of them. You can pay by check, you can pay by what? Cash. So that is what you do over there. All forms of payment happens there. All right, take note of that. Then here too, all forms of receipts. All forms of receipt comes here. So it can be cash, it can be bank. So that is that. The receipt can be from customers, all right, or it can be some advance payments you collected, but most of the time it's from customers. Is that okay? So that is that. All right, so basically that is that. Now, these receipts from customers may come from sales. All right, so we have credits or cash sales. Receipt from cash sales. All right, so that one, if you sell in cash, you collected money. But this one, the suppliers, it means you did purchases. All right, purchases. Expenses too, you paid expenses. Then you may also pay for maybe assets, but buying assets on cash. All right, so all forms of assets you buy on cash. So those ones too will be here. Now, then you have drawings, cash drawings. All right, cash drawings. Now, sometimes the drawings will not be given, and that will probably be your missing figure. Okay, but if drawings are given, then it means that you are looking for your balances. So let me put Z here. It can, or if any of these things is not there, then that is the missing figure. It can also be receipt from customers. It can also be your kind of cash sales or so, anything, any one of them. All right, so you can close the account. Watch this. When you are closing the account, because the balance brought down is here, the balance carried down will be what? Here. All right, so put it in. And if the question started with an overdraft brought down, then it means that your overdraft carried down you will be here. You can have the two at the same time, so be careful. You can have these two at the same time and have these two at the same time, or you may not. All right, so just be careful with that. Then you balance off your account. The purpose of doing this one was to find the cash balances. So that is what we have done. So it will give us our balances. If the balances are already given, then the missing figure can be drawings or receipt from customers, all right, or a further cash sale. All right, so basically that is that. So that is how you draw your cash book. Then you have a sales ledger control account. So let's see how we prepare a sales ledger control account. A sales ledger control account is also called debtors account. So it is also called debtors account. So it's for debtors. All right. So it means that as for debtors, they are assets. So your balance brought down is here. Now, when will it increase? It will increase when there is a credit sale. So you have more debtors. So if it has credit sales, then that's it. Then what are the things that will be decreasing your sales? The things that will be decreasing your sales are, let's say you receive cash or any form of payment, whether cash or check, all right, from them. If you receive, it will reduce the balance here. All right, so that is that. Then let's say there is a bad debt. Some didn't pay or some will not be paying at all. It will also decrease it. Other things that will be decreasing it is return what? Invoice. All right. So return invoice, probably they also return some things for you. Or the sales that you did to them, you also give them a discount. So discount allowed. All right. So all these things will add up to the things that will decrease your sales. Now, if this is here, then it means our balance carried down will be here. All right. So if you have all the information, then the missing item will probably be your cash sales if the person has credit sales, if the person has not been recording that. All right. But if the person has been recording that, then it means that you will be looking for only your balance carried down to get your sales figure. All right, so that is that. Don't forget, we said this is an asset. It has a brought down, a debit. So you see this carried down, brought down will also be here. All right, so that is what you do. The opposite is for the purchases ledger control account, which is an account for who? Of course, creditors. All right, so you prepare that one too. Very simple account. Since it's a creditor account, creditor has a credit balance. So balance brought down will be here. So that is that. What will increase the credit side is a further credit purchase. So anytime you do a credit purchase, so if there is a credit purchase, then if it is a cash sale and cash purchase, don't forget those one goes to cash book. All right. So that is that. What are the things that will reduce your balance brought down? Of course, so this one, this is supposed to be cash receipt, okay? But I wrote cash payment from the customers, but to you, it will be cash what? Receipts. Then here, because you are the one paying, it will be payments, all right? Either cash or check. So it will reduce your owing, all right? Then here we have return inward, so here will be return what? Outwards. We actually call it purchases return outwards. All right, so that is that. And probably you also receive some discount from your suppliers. So you can say a discount that has been received on the supplier. You can do that. So discount received. All right, so these are things you go through. Then it means my balance, of course, somebody says, so don't we have bad debt in there? Purchases ledger. Then if you do that, it means that you have started planning of not paying some people their money. And so far as you have not paid, it's still an owing. All right. So this is what will happen. So it means that your missing item can be this one. All right. So that is that. Okay. So this one too, the missing item can be drawings. It can be drawings. If it is not, then it means that you are looking at some receipts that you taken from the customers. All right. So step four now is to do our income and expenditure account. So so we have income and some expenditure. So some specific expenses, we will select them and we will do an account for them. So if it is an income account, like rent income, something, all right, anything that you are receiving. So if all forms of that, so you give yourself an example, then here too, you open an expense account. All right, expenses account. Okay, so that is that. And as I explained to you, these are the 5 elements of financial statement: asset, liability, equity, or capital. Then income and expenditure. All right, so that is that. Now, one of them is a debit balance, one of them is a credit balance. Guess what? Expenses is the debit balance. Income has a credit balance. All right. So this one, if it has a debit balance, then it means that we have, and here you can prepay an expense or you can owe an expense. Don't forget, prepayment is an asset. Okay. So therefore, what you do is that your opening balance, so we have a prepayment. If there is a prepayment, so prepayment brought down will come here. All right. In the same way, if there is a prepaid income, it will be the opposite. So prepaid. All right. Or we call it an advance income received. Owings will be here. If it is an owings brought down, it will be here. So opposite, owings brought down here. Then, since these ones are the opposite side, prepaid carry down will be shown here. And owings carry down will also be shown here. The same way, it takes the opposite ends, always carry down. So be careful of brought downs and carry downs, all right? So prepaid, carry down. In between, we have the here and this side. So for the expense, we have the expenses, that particular expense that you incurred during the year, which is going to your P&L, will be here. All right. Then any cash payments or any payment, whether cash or check, will also be here. So be careful. One of these will be the missing figures. All right. If you have your closing balances. So that is that. Be careful. All right. Normally, the payment will be given because of the cash book. Then you realize that the difference is something that must go to your P&L because you are going to prepare an income statement. All right. So normally, fish out for this because that is the one you need. The same way here will be the income. All right. The additional income. So the income that will be going to the SPL will be here. And the cash receipt or check receipt, all forms of receipt, it means you received the money to be here. Most often, this is the one you'll be looking out for. So be careful. All right. That is when you have your closing balances given you. But if you don't have your closing balances, then it means that but most often you always have your closing balance because when it comes to income and expenditure, we don't take balances like this because that one is going to the P&L. So it is always one of these two. All right. So that is that. Now that we are done, let's pick up a question, which is your tutorial set question 2. And we will deal with that quickly. All right. So that is that. Let's pick the question. But before I do the question, let's do this. So once you are done with this, you know that you are going to prepare step 5, prepare your P&L, right? Income statement. So you prepare your income statement. You know how to do this. We've done it several times. So you need your sales, right? And your sales came from workings 3. All right, you will need your sales. So that is that. Then as usual, you less cost of sales. So if you less cost of sales, your cost of sales, what do you remember? You get opening stock, right? So your opening stock. Then you add purchases. Now the purchases is coming from where? Your workings 3 also. All right. Then you add it up. So then you less what? If there is goods drawings, don't forget, all right, deduct the goods drawings. So this is what we can do. You can decide to bring your purchases here. Now, if there are, where's our purchases ledger control account? So this is for trade debtors. But in terms of stock inventory, then what we are going to do is that if there are drawings on stock, please don't forget, you less the drawings. Drawings on stock, all right? So less drawings. So once you less drawings, you get cost of goods available for sale. All right, cost of goods available for sale. Then you less your closing stock. So once you less closing stock, you will get cost of sales. So now, what do? We can deduct and get our gross profit. So that is what we do. Now, after you had your gross profit, you add any other income, okay? Any other income. So the other income can be any sort of thing that came out from workings number 4, all right? Anything here or any other thing. So you fish that one out from your workings number 4. All right, so you put it there, you have your income. So you have this. Then what do we do next? We less our expenses. We less expenses. So the expenses, for example, we have depreciation, All right, as you know, so depreciation on all fixed assets, you will list them. Okay, then you bring in all forms of expenses, let's say rent and all those things. So all the other expenses, but be careful. The thing is that the figure that is coming to this P&L is a figure that we probably have found here. All right, so that is where it's coming from. Just as our other income came from that route. All right, so that one will give us the figure. So that is from workings what for also. So that is what you do. You add all those expenses up. You add it up, then you will deduct. Then you get your what? Net profit. Now, don't forget, once we have the net profit, it means the thing that we don't have is our closing capital. Don't forget that we said that opening capital plus what do we call it? Plus additional capital minus drawings plus profit will give us our closing capital. So it means that the last phase of what we are going to do is to do the balance sheet. All right. So we are going to do the balance sheet. Now, when we do the balance sheet, then we will obtain issue balance because that is our closing figure for the capital, that side, finance by side. All right. We will start with the stated capital or the capital that we had during our workings one. All right. So let's draw the balance sheet down. Okay. Let's draw the balance sheet. So this is how our balance sheet will look like. So take note of this because in the next video, we are going to solve all the questions. Okay. In the next video. So learn this format and everything that we are doing so that in the next video, when we pick up the questions, it's a straight go. All right. So how then do we prepare the balance sheet? Okay. So this is how we do it. So we put the name of the person. Then we will do balance sheet or statement of financial position. All right. So let me do a statement of financial position. So statement of financial position. All right, position as at. So you put your date there, you underline linely. All right, and just as we've been doing every day, the same thing, nothing changes. So we have the cost, accum dip, then we have what? The net book value. So you put your CD signs. All right. So you start with your fixed assets, and we all know the list of fixed assets. So if you are lacking, then visit the lecture 1 or video 1. All right. So you total all these sites. After you have listed them, that is what you do. Then you come to your current assets. You know your current assets comprise of closing stock. All right. So that is that. So you bring it in. Then what else? Debtors. Good. Now your debtors or your receivables, trade receivables, is coming from here. So your workings 3. All right. Where are you? Workings 3. So this is the figure you are picking, which was also here. All right. So that is the figure you are picking. So we will go and slot it in. All right. You slot it in. Don't forget, all bad debt and things has already been taken care of in that ledger. All right. So that is that. Then what is the next thing? The next thing you should be careful about is prepayment. Prepayment. Now, where can we find that? The prepayments can be found here. So you go to your expenses account. You see this prepayment. This is it. It's going to your balance sheet. All right. Balance sheet. That is it. Now, if you also receive prepayment on income, That one will be a reduction. All right. So that is that. But normally you don't have a prepaid link. I mean, somebody paying you. It means that we won't use that. We will take it to the liability account, because if you collect somebody's money in advance, it means you owe the person. So visit the expense part to pick that. All right. Then, of course, you have your cash, bank first, then cash. Don't forget, these ones too are coming from which workings? Workings 2, right? Workings 2. Where do we find these figures? Let me show you. When we prepared our cash book, like I told you, our focus was to look for the balances, but if the balances are given, we will only be having the issue of drawing. So this is it. These are the balances. All right. If it's an overdraft CD, then this one will go to our liabilities. So this is it. Don't forget. So now you have it. You have them. You have them. So total them. You total them. Then what do you do? Normally, we less current liabilities, right? So less current liabilities. Payables. Start to trade payables. You know where to find it. The balances at workings 3. Okay. So after payables, then expenses, owings. All expenses that you are owing and all incomes that you have pre-collected. So, but most of the time our focus is on the expense. So this is the part I was talking about, this one. All right. So that is that. Now, don't forget our purchases ledger control account. This is the one that we picked to our balance sheet. All right. So that is that. Okay. So that is the one that I wrote earlier, the trade payables, that one. So this one too comes from our workings 4. All right. Then overdraft. Overdraft. So the overdraft carry down that we had in the cash book. So that one was coming from our. So you add all these 3 and you come and deduct from this one. Then you get your figure here. So here you get your balancing figure, adding it to what you had, all right, at the top for your assets. Okay. So basically that is that. So I think you know up to this point. Then the last one is financed by. So that is that. So I will do the next video will take care of solving tutorial questions 2 and tutorial question 3. So financed by our opening capital. Do you remember? Opening capital. That was from workings 1, right? So you have that. So you have it. You add net profit. Net profit. So you have it here. All right. So you get this. Then what do? Don't forget, as we used to do, you less drawings. Don't forget that. Okay. Don't forget that. Less drawings. Okay. So that is that. Less drawings. So once you less your drawings, you are able to get your closing capital. So this is it. And drawings here, be careful. This is cash drawings, all right? Like cash drawings from capital, from capital. So that is that. If it is goods drawings, what do? You deduct it from the inventory, all right? Closing inventory, because we did it from the purchases, all right? So that is that. But if these things are inside the footnote, don't forget that all of them. So you treat the goods from the, what do we call it? The closing stock, and also from purchases. All right. Then if it is cash drawings, it will affect your cash book. It is also affecting your what do we call it? Your cash balance. All right. So if there is the drawings on capital, and the drawings on capital is what you found from your cash book, which was workings what? I think that was workings 2. All right. So that is that. You found it from your workings 2, so you slot it in there. All right. So take note of that. All right. So ladies and gentlemen, this is how we actually balance everything. So the next thing we will be doing is actually to solve all the questions that pertains to incomplete. Now, before I go, there's one last thing I need to show you, which is about the fact that sometimes goods may be stolen. So if goods are stolen goods, if goods are stolen, what will happen? It tells us that if goods are stolen, it is going to reduce our closing stock. Is that not it? Yes. So that is what is going to happen. So it is going to reduce our closing stock if they steal goods. So where you do opening stock, add purchases, that one will also be deducted, just like the drawing. So if there are stolen goods, so stolen goods, my pen is freezing. So stolen goods without insurance. If they steal the goods, so you will deduct it from your purchases. Now, so that is that. It is against you. Now, what will happen is that if the goods are stolen, so this one is the SPL. Now, in the balance sheet, what will happen is that it is going to affect our closing stock. All right. So you also deduct the stolen goods from closing stock. All right. Closing stock. Some people can decide not to put it in the closing stock. They can decide to just deduct it from purchase and also treat that stolen goods as bad, like the way we treat bad debt. So that is that. They can actually decide to do that. Okay, so take note of that. So if they are stolen goods, that is what will happen. Okay. So now, what if the goods are insured? If the goods were insured, then it means that as you deduct it from your trading account, which is your purchases, the corresponding entry here will be that it is a claim. All right. You have, so when you say a claim, it means that you are telling the insurance company to pay you. So this one first is without insurance, but with insurance, what you do is that you deduct it from your, what do we call it, your inventory. So that is what you are going to do. It is affecting your purchases, but the money is not all lost. What is going to happen is that you are going to receive the money. So you do a receivables from the insurance company, and we will take a question in the next video. So it will be a receivable in the from the insurance company. So basically that is that. And when the insurance people gives you the money, then it means that it is no more a receivable from the insurance company. You have received it, therefore you will credit the insurance company. All right, then you debit your cash and bank because you have received the money. So we will take a look at this again when we start dealing with the questions. All right, so watch out for part 3. God bless you. Bye-bye.